I'm here at the London Landmark Hotel for EPRA's annual conference. Joining me is David Sleath, the Chief Executive of SEGRO. David, how are the first few months as the Chief Executive of the company going for you, and has it been what you expected?
Yeah, thanks, Matt. Well, it's been a very interesting few months. Obviously, I know the business very well. I've been with the company for 6 years, most of those as the CFO. And it is a different job, though, being the CEO. And so one of the things I've been doing over the last few months is taking a good look at the company, looking at our properties, talking to our customers, talking to our people on the ground, and really getting a good feel for the for what the business is and where we can take it going forwards. And in terms of my main focus, it's been very much around operational delivery. That's what the first period has been about, and we announced our half-year results last week, which were very encouraging, with earnings up 10% at the profit before tax level and 8% at the earnings per share. And that was on the back of a real focus on leasing, customer and asset management, cost control, and building the development pipeline. And we made good progress in all of those areas. So it's been a good few months and a good start, and I'm enjoying it so far.
And those conversations that you've had, what have they told you about the overall state of the European industrial market?
Well, the market's been in a slow recovery phase for probably over the last 12 months at least. We've seen some pockets of encouraging activity in certain geographies and certain sectors. So for us, the bulk of our portfolio in the UK is 92% of it, in fact, is in London and the south of the country, which is the strongest economic zone. We've seen a number of sectors growing their space requirements. We've seen retailers, fashion retailers and food retailers in particular. We've seen some of the technology industries like data center operators requiring more space. And we've seen some high-end manufacturers, so higher tech manufacturers requiring space. So that's been pretty encouraging in terms of the activity. And that's been helped by the fact that the overhang of space that was developed in the last boom part of the development cycle has now largely been taken up. So there isn't a great supply of Grade A, new quality industrial real estate space available in London and the South East, and that's feeding into good demand for the space we do have left to let, and also into inquiries for new pre-let developments. So that's London and South East, which is the real heart of our portfolio. In terms of the other exposures in continental Europe, most of our investments are in what we call the big three: France, Germany and Poland. France has been really about Paris for us. That's where most of our assets are concentrated. It's a similar story to London, different economy to the rest of the country. So it's been recovering reasonably well. Again, food retailers have been strong. A number of local distribution businesses have been demanding new space. Germany's been a strong story on the back of the manufacturing base that they have there, largely exporting, of course, to Asia and the East. But Germany's been doing well, and again, we're concentrated in the main economic centres, the big five cities there. And then Poland, and Poland's been a growth story, whereas the rest of Europe went into recession in 2008 and 9. Poland kept going through. It grew at something like 4% last year. And whilst that market has been suffering a little bit from oversupply, again because of overdevelopment in the last cycle, most of that oversupply has now been taken up, and we've got a very low vacancy rate down at 3.4%. So it's been an interesting story, but the key areas that we're focused on have been in a gradual and steady recovery.
And drilling back down to the UK, looking out at the next 12 months, do you expect those positive results to continue?
Well, I think we're going to see a continuation of steady growth. I wouldn't be at all surprised if the most recent events in the US and in the Eurozone and potential signs of slowdown in Asia too have some impact on demand. Over the last 2 years, whilst we've seen a gradual recovery, when there has been some kind of external shock event, it's tended to slow down new inquiries and even the completion of letting deals that have been in the pipeline for a month or two. But nonetheless, the overall trend has been a gradual recovery, and I think that will continue because there isn't a lot of new space available. There are very few people doing any development, and where they are, it's almost entirely pre-let development in terms of industrial space. So I think we should see a continual slow recovery in these markets.
And last question, what are your views on some of the other issues that you plan to tackle here in the next 12 months or so?
Well, as I said earlier, I'm having a good look at the business, and there's no doubt in my mind that the focus for the foreseeable future will continue to be around operational delivery. So driving up our operating performance, our occupancy, controlling our costs carefully, trying to get some value out of our land bank. Longer term, then the question is, well, how can we really drive performance from the portfolio going forward? And that's something that I'm having a good look at, looking at how we can build on the success we've got, on the particular pockets of strength we have. And in fact, I'm going to be holding an investor and analyst day in November when I'll be sharing some of the thoughts around where we go next as a business at that stage.
Great. Well, David, we look forward to watching that journey. Thank you.
Thank you.
Great. For more news and analysis, be sure to visit REIT.com as well as EPRA.com.